Welcome to the B.F. Anderson Techno Fundamental Report for November the 6th. You know, it's really amazing how I saw the statistic and I thought it was so interesting. This is global central banks that have been cutting their rates for the last 2 years. And as of September 25th, we've had 312 cuts, which almost, is in line with the great financial crisis. So the banks are definitely either printing a bunch of money and cutting rates. U.S. debt has gone up $10 trillion in the last 5 years. Kind of troubling. Are we in a bubble? Well, if we look at the not financial crisis, but the dot-com bust, and if we take the peak, which was March 24th, the PE ratios based on foreign estimates, forward estimates. For Cisco, it traded at 130 times, whereas NVIDIA right now is at 30 times. So, the question is, are we in a bubble here? You can use mathematics, but the problem is sometimes mathematics run head into the actual reality of price, which means the ticker tape. So when you think about that reality, and this is something straight out of the book that I've been mentioning, he said there's another thing to remember, and that is a market does not culminate in one grand blaze of glory, so it's not going to be obvious. Neither does it end with a sudden reversal of form. A market can and does often cease to be a bull market long before prices generally begin to break. My long expected warning came to me when I noticed that one after another, those stocks which had been the leaders of the market reacted several points from the top and for the first time in many months did not come back. Their race evidently was run, and that clearly necessitated a change in my trading tactics. So it's back to the generals that are leading, and we are noticing that a lot of the AI stocks, including NVIDIA, Amazon, Apple, some are reacting okay in this environment, but they're not really making new highs like they were several months ago. So it's just something to be aware of. So let's look at the total picture here. I want to look at 5 indexes. Now, the way this is set up, you got the 50-day moving average and you've got the 25-day moving average. The name of the game here is for the index to stay above the lower moving average, which in this case would be the 50-day. So if you take the NASDAQ, there's no problem. It's holding above both moving averages, and it continues to be in an uptrend. However, the point I want to make here is that we're going to look at 5 indexes. Now, 3 out of 5 have to make this type of criteria, so let's look at some more. This is the mid-cap index, which is a different group of stocks. You can see it's been pretty much moving sideways, has broken below both moving averages, trying to rally up into here. So this is not what we're looking for. So this would be index number 1. So index number 2 is all the stocks on the New York Stock Exchange, below both moving averages. Now, the other part of the rule is you want the lower moving average turning down. Now, you see here the upper moving average is turning down. Now, let's look at the small caps. Now, the small caps kind of rallied today after being pretty devastated. You can see below, both moving averages trying to rally up. So these, out of the 5 indexes that I'm pointing out, and here's the S&P 500, it's all NASDAQ and S&P, which is primarily large cap stocks. So let's look at the number of new highs versus the number of new lows as of today, which is Tuesday, November 4th. We're hitting a new low. So there's not a lot of stocks making new highs, and there's a whole bunch of them making new lows. That just cannot be a positive. So we need to be very cautious here. Now, you notice here, this is the aggression index. This is where we're comparing the NASDAQ to consumer staples. And by the way, we're going to talk about consumer staples because something very interesting going on there. Point being is, this looks extended to me. It's making all-time new highs here. I've been keeping this ratio for a long time, and I can't remember a time. There have been times where we've had major moves, like this is coming off the bottom of the market on April the 7th, but I just can't remember that many that were this extended after an extended period of time where the market's been going up. So I kind of view this as more of a warning than a positive, but the aggression index is definitely aggressive. The primary trend continues to be up. We're above the 200-day in both of the major indexes. So that is our definition of a bull market. So we are in a bull market. Now, another negative here. We've got a lot of new lows coming in here on the New York Stock Exchange. So we're measuring, number of new lows on New York Stock Exchange. You can see several days ago we got over 130. Just as of today, we're over 100. And if we get over 40 a day, statistically, that's just not good. So we're very cautious here. Bull-bear ratio. This is, I heard an analyst talk the other day about how he thought this was probably the best way to measure sentiment. And as you know, you don't want a bunch of positives. You want negatives because that's how bottoms are made. Well, for the first time in a while, we've gotten a little bit of an uptick in optimism, which is not good. That's a negative. I wanted to mention Bitcoin. Bitcoin is kind of another way to measure sentiment because it's, I'm not a big fan of it because I think it's like the tulip craze back in the 1630 in Holland where people went crazy over tulips, and just reality is they're just tulips. But anyway, we got these Bitcoin fanatics out there, but this trust is really breaking on down. This is the iShares Bitcoin Trust, which I think fairly reflects what's going on with Bitcoin. Now, Bitcoin could be the risk on or risk off, and right now it's kind of looking like risk off. So people are, pretty pessimistic about it. Now, I did want to mention the consumer staples. Now, notice here, Procter & Gamble is making a new 52-week low. And then if we look at the ETF that measures consumer staples, you can see it as well is making a 52-week low. Now, these are very defensive companies, and, soap, toothpaste, toilet paper, that kind of thing, ketchup, mustard, Heinz ketchup. My point is this particular group of stocks usually, is a measurement of fear with the institutional investors because they really can't go to cash. But, this is unusual for these stocks to be coming down like this because it means they're being sold. And where's the money going? Is it going into gold? Where's it going? I don't know. But the point is, keep an eye on the consumer staples. Something's going on there. I just don't know what it is. We'll find out later. Thank you very much.